this afternoon, as I said, is about ESG. And so what we're going to do is we're going to have a high-level look at ESG investing. As ever for these events, we like to take an educational approach. And so please, sort of when Jan is talking later on, bear that in mind, that the event today is supposed to be educational. We'll have the Q&A operating for you, so you can post questions to us through the Q&A, but we're going to deal with those at the end. Jan is going to talk for about 30 minutes, and so we've got him for about an hour, so we've got plenty of time for questions at the end. So please don't be shy in coming forward and throwing questions into the Q&A. Now, the sort of things that we're going to cover: we're going to define ESG investing, what it is and what it isn't. We're going to talk about the differences between ESG, SRI, which is socially responsible investing, and impact investing. We're going to talk about the different approaches to ESG investing, the differences between risk and return. What are the risks involved? What are the returns like? How do they compare to each other? Try and help you understand that there is no one-size-fits-all approach to ESG investing, and some of the difficulties that come from trying to create bespoke portfolios. Now, here's a thing that I think is very relevant, that some of you may remember that the ESG investing came up for us at one of our very early client advisory board meetings, which I think from memory was December 2018. And the board was saying to us that we really needed to develop ESG portfolios. And, as ever, we take those things on board. And it took us around 9 months before we'd been through all the various parts of due diligence that we needed to do. And this area is what may seem essentially quite simple. We want to have an ESG or an SRI or an ethical portfolio. The due diligence requirements for that as planners, where we're trying to deliver a market return less fees for the risk that you're taking. The due diligence is really, really difficult. Hence, it took around 9 months to 12 months to be able to formally launch our ESG portfolios. So Jan-Carl's certainly going to talk about some of those issues and the trade-offs that investors need to consider when looking at this. And towards the end, we'll also be able to talk about what's known as active ownership, which is really the governance side of the ESG, in terms of the active role that Vanguard or other managers will take in relation to using their strength as shareholders to influence companies and boards on the direction that they're taking. So I think that's pretty much it from me. I just need to tell you a little bit about Jan. Jan-Carl Plagge is a senior investment strategist in the investment strategy group at Vanguard. He focuses on indices, active and passive management, and ESG investing. He's had papers published in peer-reviewed journals and has presented his work at various practitioner and academic conferences, which is where Marcus and I first met Jan earlier this year at an investment conference that we were at, and thought that he was a very good speaker and had a lot to say and would add a lot of value to our clients. So he has over 14 years experience in developing passive investment strategies and index research. Prior to joining Vanguard, was head of research and co-head of product at Stocks, working in Frankfurt, New York and London. Has also held index development roles with Deutsche Börse, where he was responsible for the development of international equity and strategy indices. So without further ado, I'm going to hand over to Jan for about the next half an hour or so. As I said, please don't hesitate to throw questions into the Q&A and we'll deal with those later. So Jan, over to you.
Thanks a lot, Dom, and hello, welcome everyone also from my side. Well, as the title of this presentation, which you hopefully see in front of you on the screen, is ESG, SRI and impact investing, we call it a primer for decision making. As we've seen that a lot of our clients, market participants, still struggle with regards to the terminology out there, nomenclature out there. There's quite some confusion linked to all those terms, and of course they don't make this confusion doesn't make it easier when it comes to decision-making processes, etc. In fact, I've attended conferences myself over the years where it wasn't really clear to the panel what the definitions that individual speakers used when they spoke about ESG were, and of course that's not really helpful when it comes to this entire debate more generally. So the idea of this presentation is to walk you through all the different terms out there, but also walk you through the different investment strategies out there. And as you see, all of those components are framed into a decision-making structure or into a suggestion for a practical decision-making framework. Switch to the next slide. So the learning objectives are, as mentioned, first of all, understanding the different forms of ESG investing, the different ESG strategies, but then also to learn how to structure or potentially structure a decision-making process for ESG investing. Before we go into the structure itself, I just wanted to say a few words around the growth of ESG investments over time. What you see here in front of you are figures as composed by the Global Sustainable Investment Alliance. They have a quite broad definition of ESG, I would argue. At the end, their definition of ESG, and we will come back to their definition of ESG over the course of the next couple of slides. Following that definition, you see that we have roughly $30 trillion invested in some type of ESG product at this point, or this is the data refers back to the end of 2018. Unfortunately, that study is updated only on a biannual basis. So I'm sure over the course of the last year and a half, so that number grew even more, but even by the end of 2018, assets under management exceeded already 30 trillion and grew quite significantly from 2014, so over just 4 years, by almost 70%. So what all of those data sources, irrespective of the level that you end up with, have in common is that they would all show you quite substantial growth rates in ESG. Even after controlling for the growth of the markets, there is still quite some growth left, which really is due to additional asset inflows into ESG products, which I think makes it even more topical that we talk about it at this point. As mentioned, there is a proliferation of terminology out there which leads to confusion in many cases. You may have heard not only ESG investing, but also terms such as socially responsible investing, impact investing, norms-based or value-based investing. In many cases, all of those terms are used as synonyms. We see in a couple of minutes that related terms such as exclusion-based products, inclusion-based products, those are not terms or synonyms for ESG investing. They're really linked to the way that products are constructed. But a lot of those terms you see here in front of you are really used as synonyms for ESG investing. We at Vanguard decided to go with the term ESG investing as an umbrella term, so to say. According to our definition, ESG investing refers to any investment-related activity that accounts for some type of environmental, social, or governance consideration. I think most of you are well familiar with the environmental sides, as it really relates to how companies interact with perform as stewards of the environment. Social, I think, is also still quite straightforward. It's typically refers to how a company manages relationships with its stakeholders, not only with its employees, but also with clients, with suppliers, or even with the entire community within which a company operates. What is to investors oftentimes not that straightforward and not that clear is the governance side. So there are various different definitions, but I think it's fair to say that the governance dimension refers to the way that companies' objectives are set and are often or is often measured by looking at the company's boards, so the independence of board members, for example, the diversity of board members, the qualification of board members, etc. I just mentioned that the governance side is often less well understood by investors, by retail investors, for example. What is interesting is that it's very well understood by researchers. If we look at research and papers that have been published on the impact of ESG considerations on financial materiality, on risk and return, etc., a lot of those papers are very closely linked to the governance side. So there is a bit of a mismatch between the investor's perspective and knowledge about that last dimension and the focus of academia here. Now, given that definition of ESG, we came up with a 4-step process, which might be helpful to investors when it comes to making a decision for or against a particular ESG product or for or against ESG investing at all. And as you will see over the course of the presentation, at the top right-hand side, you always see where within this 4-step process we are currently at. It all starts with step number 1, quite obvious, it's about defining goals. And you see that there are actually 2 sub-steps here in a minute. The second step is evaluating options. And this has to do with understanding all the different investment strategies out there, and we will walk through them one by one. Step number 3 is deciding on actions. So once we understood the goals, once we have defined goals, once we know all about the different options, it's about bringing it all together and making for or against a particular choice. And step number 4 is then the reassessment of a given choice on a periodic basis. As of course, I think we're all aware that the number of ESG vehicles, investment vehicles, grew quite significantly in the recent years, and the expectation is that this growth will continue into the future. So of course, a choice that may appear optimal at this point in time may not be optimal anymore to give an investor a couple of years down the road. So I think there is some value in a periodic reassessment of a given choice. But let us start with step number 1, the definition of goals. As I mentioned, there are actually 2 sub-steps if you think about it a bit more closely. The first is identifying issues that matter most. And you see here on this slide a non-exhaustive list of issues that may be important to investors. And even this non-exhaustive list includes many different issues that investors may want to see addressed. And at the end of the day, we can really link pretty much all of them to the aforementioned 3 dimensions: environmental, social, and governance. Just to name a few here, on the environmental side, I think fossil fuels is probably the area that has been discussed the most in recent years. The low carbon debate, for example, would predominantly fall into this category. But there might be investors that want to address other issues such as waste generation, want to make sure that companies have proper waste management system in place in order to mitigate the pollution of the environment, etc. On the social side, animal testing and the prevention thereof, alcohol, tobacco are probably quite well-known examples. Specifically on the index fund side, you may have come across products that include ex-tobacco or ex-alcohol, ex-adult entertainment, etc. All of those things as part of the names even. So those are popular examples of products that would address specific social issues. And lastly, on the governance side, as mentioned, this dimension has to do with the way that companies' objectives are set. Key performance indicators as measures are often referred to may look at board diversity, at the qualification of board members, at the independence of board members, etc. In many cases, those the governance dimension may not be referred to in a product's name, but you will see it if you look at underlying index methodologies, etc. So once issues are identified and an investor has determined which issues matter most, the next step would then be to set objectives, to link objectives to the respective issue. And as we see, and this adds to the complexity in this space, there isn't just one objective. There can be very different objectives, and there can be different objectives depending on the issue, which increases the number of possible combinations quite substantially. And we listed 4 quite typical objectives here on this slide. The first is satisfying values preferences. Religious beliefs, moral preferences, for example, would fall into this category. You can also refer to that category as something that isn't pecuniary. It's utility that investors get from an ESG dimension, which might be independent from risk and return considerations. On the top left-hand side, there is another non-pecuniary objective. It's about effecting meaningful change. So active ownership, for example, would fall into this category, as we will see in a moment. Then on the right-hand side, you have also perfectly valid objectives that are often mentioned in the ESG space, but they are now more pecuniary in nature, or at least to the one at the top right-hand side. It's about generating financial benefits. And we see there are investment strategies out there. The ESG Integration, a strategy that we will discuss in a moment, would fall into this category, which is really more about generating financial benefit, increasing risk-adjusted returns. And it's oftentimes just a means to an end. It's the end is increased risk-adjusted returns. ESG interpreted via risk factors is the means in this context. And then lastly, the objective might just be meeting certain legal or probably better regulatory requirements. So as mentioned, step number 2 has to do with evaluating investment strategies. But first of all, before we can go into the evaluation, we have to understand what those ESG strategies actually are. And if we look at the broader cross-section of products out there in the marketplace, I think we can link almost all of them back to 4 categories. The first is ESG integration. The second is active ownership. Third is portfolio screening, and the fourth is impact investing. And over the next slides, we will walk through them one by one. Here you see description, so to say, of ESG integration. I would argue that ESG integration is probably the oldest form, or among the oldest forms of ESG investing. And many active managers would argue that they have considered ESG factors as part of their stock selection process, for example, for many, many years, if not for more than a decade even. So the idea here is to also consider ESG related characteristics, governance risks, for example, social risks or environmental risks that companies face, as part of the decision or of the attempt to determine whether or not a company is overvalued or is undervalued relative to its fair value. And if or the result of that decision is that given all of its risk, including ESG risks, that the company might be undervalued relative to its fair value, such a manager would invest in the company, overweight into the company, and vice versa. So ESG is used as part of a broader set of tools, and you see other tools mentioned here, SWOT analysis, valuation measures, etc., in order to determine whether or not a company is a good investment or not so good an investment, mainly with the to increase risk-adjusted returns. And in many cases, you may not even know that an active fund, as this is something that active funds typically do, that an active fund would consider ESG as part of all the different tools they utilize in order to achieve their goal, to increase risk-adjusted return and potentially beat a given benchmark. So as mentioned, this is a technique that's around for many years, and many active funds in this day and age employ ESG integration as part of their standard toolkit. Now, a second way of approaching ESG, a second ESG strategy is called or referred to as portfolio screening. And if we refer back to the initial slides that showed assets under management, I think portfolio screening is, in terms of AUMs, the most important, or the largest category. Here we can distinguish between exclusionary approaches and inclusionary approaches. And as the names already indicate, exclusionary approaches are about excluding certain companies. Typically, it's about excluding companies that are considered investors with an exclusionary approach may want to avoid exposures to certain industries, certain business practices, etc. Inclusionary approaches is all about including only the good actors. The difference between those two can be quite substantial. As if we think about it, if we start with a broad market exposure, an exclusion-based approach, what is an exclusion-based approach typically left with? It's left with good ESG companies and neutral companies. So the impact relative to a broad exposure can be or tends to be quite small, as it only excludes bad actors. Inclusionary approaches may have a much more significant impact relative to the starting point, as if we only keep good actors, we exclude not only the bad actors, but also the neutral part in many cases. So I think that is one element worth considering when it comes to making a choice for or against exclusions and inclusion-based approaches. Now, I thought in this context, it might make sense to share one slide with you, and I don't want to confuse you with all the information that's displayed here, but it also helps to think better, I would say, about exclusions or exclusion and inclusion-based approaches, as a lot of those strategies have to do with two different questions, and this is all that I want to show you here on the slide. The question on the top of the slides, or the two questions on the top of the slides. The first is, what do companies do? And do I like what companies do? If that is most important, an exclusion-based approach is probably the right choice, as that's exactly the question that exclusion-based approaches answer. They look at companies and where companies generate their revenues, and whether or not the source of companies' revenue generations is agreeable to an investor or not. If it's not agreeable, if a company generates revenues with certain unwanted or in certain unwanted sectors, for example, it's excluded. The revenue source is oftentimes quite easily determinable. It's quite objective. There isn't really that much doubt about sources of revenue. There is still some debates in the market with regard to the proper exclusion threshold. Some products would exclude a company as soon as it generates $1 in a given sector. Other products would exclude a company only after its revenue threshold exceeds a certain level, 5%, for example. But at the end, the decision determining where companies generate their revenues is quite straightforward. On the right-hand side, you see a different question. It's about how companies do what they do. And this is a question that many inclusionary approaches try to answer. And you already see from the nature of the question, the answer to the question how companies do what they do is much less straightforward as compared to answering the questions what companies do. How companies do what they do would look at whether or not a company treats the environment well, treats its employees well, has a good governance structure, etc. And the answer to that question can also be much more subjective. So there are oftentimes analysts that look into companies' reportings, etc. So I think that is one very important consideration to keep in mind when it comes to distinguishing between exclusion-based and inclusion-based approaches. Exclusion-based approaches are oftentimes based on more objective information, I would argue, as compared to quite a few inclusion-based approaches, which has to do with the nature of the underlying question that is asked. Now, a third type of investment of ESG strategy is active ownership. And this is actually a quite different approach. Screened strategies, those that exclude companies, would, if you want to say so, vote with their feet. So if they don't agree with a certain sector, for example, they would just divest from a given sector. Active ownership isn't really about divesting. It's about it can even be about investing in companies in order to exert some influence on the company with the aim to steer the company away from a given business practice or towards a wanted behavior or business practice. And there are certain means that active owners employ. It can be engaging with a company, which I think is probably the most common technique, engaging with a company's management or a company's board of directors. It can be more formally writing letters to companies, or it can be voting for or against certain initiatives. So I think it's important to distinguish between active ownership and the screened products. Screening is often about divesting from companies. Active ownership isn't really about divesting, it's about investing or staying invested and then interact with companies in order to move the company into a certain direction. And lastly, this is the fourth ESG strategy. It's in terms of assets under management by far the smallest, also because it's quite complex, and a lot of those transactions may not even happen in the public, but in the private market. It is impact investing. Impact investing is something where investors usually have a dual objective. There is always a societal impact, so they want to do something good, but at the same time they also want to generate financial returns. We've listed two examples on the right-hand side. One is a private real estate investment where they want to revitalize the given neighborhoods, but at the same time that investor also understands that or assumes that the real estate is currently undervalued, and he hopes for a correction in price at some point in the future, which would then generate a financial return at the same time. Or second example is linked to green energy or green technology venture capital, where the assumption is to reduce carbon emissions with given technique, but at the same time that investor is also well aware of the growing market in green energy. Last example, I should definitely add it here to the slide at some point, would be green bonds. I think it's probably one that quite a few of you are familiar with, where of course the proceeds might be used in order to finance a green project, but at the same time the investor is obviously also after coupons, etc., which would then fall into the financial returns category. Yeah, so at this point we have understood issues as part of the objectives. We've linked objectives to issues, and we now know about the different investment options, ESG strategies that are out. How should investors now think about it? How should a decision be made? That's arguably, and of course, the most important, but also the most complex step in the entire process. Unfortunately, I think there isn't an elegant mathematical solution that we can derive that would give or lead to the optimum for every investor, mainly because a lot of what happens here is very individual, specifically the first part when we discussed issues that are out there and objectives. There isn't a one-fits-all issue or a one-size-fits-all objective. That part is very individual, and investors may have very different issues and objectives that are important to them. What is also important to mention here is that when we link issues and objectives to available products, there may be the need, or there will most likely be the need for a trade-off. As if you start thinking about issues without having products in mind, come up with a list of issues and look at the available product range, it may easily be the case that the available products may not tick all the boxes, or may address an issue that an investor may not even consider to be an issue. So I think there is definitely some complexity there linked, or when it comes to linking individual issues to the range of possible products. The second part, and this, if you look at this slide, falls into the left-hand category, is more pecuniary in nature. When it comes to deciding for or against a given ESG product, what is important to keep in mind is what that ESG product may replace in a portfolio. If it may replace a non-ESG, an ESG agnostic broad market exposure, for example, an index fund, you may think about it in terms of relative risk or of deviations in expected returns, in risk, etc. And unfortunately, that's what our research shows here, and we've looked into various ESG equity funds as they fall into the different categories, exclusion-based, inclusion-based, and index fund and active fund. Across all those categories, we found that funds perform not only quite different from the markets, from the non-ESG benchmark, so to say, but also quite different from one another. So we had ESG funds, even in the index fund category, where you might assume that those funds are quite homogeneous, that underperformed in a given period, and another ESG fund outperformed over that same period. So our research shows that we can't say that ESG funds collectively outperform, or that they collectively underperform, or have collectively higher or lower risk. It's really mainly about individual fund characteristics. What industries do they screen out? To what extent do they deviate from the market? So asking the question whether or not the move to an index fund will come, or whether or not the move to an ETF strategy will come for a price for higher returns or lower returns is actually the wrong question, as there isn't something such as an ESG fund. There are only individual representations and individual strategies, and our advice is to really assess those individual strategies on a fund level basis in order to see what the implications are. As if there is one thing that we can be quite certain about, it is that if you start screening out industries, for example, that comes for one price, and that one price is, or that price is tracking error, is relative risk compared to the benchmark. It's really the only dimension that we can be fairly certain about. Whether or not the ESG fund will underperform or outperform the market is something that we cannot be certain about. There isn't a uniform direction. And Lastly, I think this is quite straightforward. So just FYI at this point, it's important to also document the decisions and all the different steps that led to the decision for or against a given ESG fund, or for or against an ESG exposure at all. And then lastly, as I mentioned at the very beginning, it certainly makes sense to reassess a decision once made on a periodic basis, as we see that there are many funds, ESG funds, that come to market pretty much on a monthly basis. And maybe 5 years down the road, the availability of ESG funds, the range of available ESG funds will have changed, might be much larger than it is now, and another constellation might be more optimal for a given investor. So to summarize, I think we've seen that there isn't really one ESG strategy out there. We see that there are very different, or we've seen that there are very different issues that investors may want to address, and there are many different investment strategies that allow investors to implement a given ESG conviction, so to say, or wanted exposure. And there isn't really any universal answer. Unfortunately, there isn't a universal answer or advice that we can give investors other than to apply a practical method in order to make a well-informed decision.
Jan-Carl, thank you so much. That's been a really interesting half an hour. I've really enjoyed hearing you talk today, and second time for me, so extra bonus. Thank you.
Thank you.
I think you've done a great job of kind of highlighting that ESG is it's an easy phrase just to throw away, but it's a really complex area with huge trade-offs between the different ways people think about it, what individual investors' priorities are. I think you've done a really good job of kind of highlighting that it's a very grey area, and I think that's a really important thing to take out of this. Obviously, Vanguard as an investment house, one of the biggest in the world. You've got some huge and currently being updated, I understand, ESG funds out there. In terms of the way you think about it, the way Vanguard think about it with those products, which of these approaches do you actually use?
Well, I think if I look at Vanguard as a whole and where ESG matters for us as a firm, there are probably 3 areas that we are active in. The first is falls into the ESG integration piece, as from an active perspective, and many don't know that we have a broader range or quite broad range of active products as well. And ESG, seen as a potential risk factor, is an integral part for many of those products. So that is, I think, one very important way where ESG and ESG considerations matter for our business. It's around the management of our active product lineup in Europe, with the specific focus on the fixed income side. A second more transparent way, more known to the outside world, I would say. Second offering falls into the product category, product construction category. And you just mentioned it. We offer a few funds on the equity side and fixed income side that employ specific exclusions that would screen out companies based on business practices, based on industry exposures, etc. So they fall into the screens category, more specifically into the negative screen category. Here we believe that at this point the objectivity is highest on the negative screen side, and not as high as we would like it to be on the inclusionary side, which is why at this point we focus predominantly on the exclusion-based approaches on the product side. And lastly, It is, which also falls into the ESG category to some extent. It's our investment stewardship activities. So this is something that many investors may not know about, but investment managers via investment stewardship teams interact with companies that are included in our products. And of course, ESG related risks, climate risk, for example, are important dimensions, risk dimensions that inform our interaction or the interaction of our investment stewardship teams with the underlying companies. So that is something which, of course, isn't linked directly to products, as our investment stewardship team interacts on behalf of many products with the underlying or with companies included in our product. So I think those are three dimensions where Vanguard as an asset manager is very involved when it comes to ESG. It's the ESG integration side, it's the product side represented via negative or exclusion-based products, and it's our investment stewardship activities.
So just turning to that, the risk factor, the ESG integration approach you mentioned there first. Does that suggest then that we view ESG companies that meet the ESG criteria, if we think about it in those terms, as potentially having greater returns than those that don't? And kind of in that vein, how's the performance of say the global ESG fund that Vanguard run been over, this particularly tumultuous period we've had over the last few months?
Oh, unfortunately, I wouldn't be able to comment on our products, as we as ISG, so the investment strategy group that I am part of, wouldn't look at our products in particular. We're just looking at the industry level, so to say.
Sure. Okay.
So what I could do is refer to our observations around ESG funds in particular. And yeah, I think there were a few interesting observations we could make over the last few months. We haven't looked at ESG integration. We have looked at predominantly looked at ESG index funds and ETFs for our study, and here focused on those that invest in the US equity markets. We chose the US equity market just because we wanted to have a clean and homogeneous underlying universe. If we would have looked at the European market, our results may have been caused solely by differences in country exposures, for example, and may not have had anything to do with ESG. But what we observed for our subsample of ESG index funds and ETFs, and most of them had some form of exclusions, so they all fell into the screens categories. Some were exclusion based, others were exclusion based. Interestingly, the majority of them seems to have outperformed over the month February and March. And if I mean outperformed, I mean compared to the broad markets represented via the S&P 500 and the Russell 1000s. But what is very important here is that we're not making the wrong conclusions, as there's some talk that ESG funds might generally react less sensitive to crisis, for example. And I think this is a statement that we would be or need to be very careful to make. I think we can't really make that based on the data we've seen so far, as we just have seen 2 months worth of significant drawdowns, if we refer to the last crisis, so to the COVID crisis. And that isn't nearly enough to conclude something around generalizable behavior of funds. And what we've also seen is that a lot of the performance and of the relative outperformance of those funds seem to have been driven by quite favorable industry allocations. A lot of those funds appeared, those ESG funds that outperformed the market, appear to have overweighted, at least in median terms, the technology sector, for example, appear to have underweighted the oil and gas sector. And we know from the nature of this crisis that one sector, the technology sector, made it quite well through the crisis. The oil and gas sector, due to various reasons, actually, didn't make it too well. So having an overweight in technology and underweight in oil and gas is something is an industry that may have significantly contributed to the good performance. And whether or not there is something left that can be linked to a truly independent or orthogonal ESG factor after controlling for the industry effect is something that is definitely worth looking into further. But I think we need more data than just 2 months worth of data to make any generalizable conclusions here.
Yeah, I quite agree. I think that's a highly sensible response. And so just turning to a question we've had in from one of our viewers today. They've asked about the UN principles. I think this is the UN Global Compacts that I know we often talk about when talking specifically about Vanguard's approach. Can you tell us a little bit about its role in the way that you think about ESG?
Yeah, I think well, as mentioned initially, I wouldn't be able to speak too much related to our products itself. So in that case, we might want to forward that question to our PRD team to follow up on that, but maybe more generally to the UN Global Compact. So at the end of the day, there are 3 categories that the UN Global Compact looks into. The first deals with human rights, the second with labor-related components, then we have the environmental, and we have the anti-corruption component. And considering UN Global Compact, or making sure that companies are UN Global Compact compliant, so to say, is typically based on research from third parties, from ESG research providers, and index providers would then consider that information and exclude certain companies that would violate or would be in violation with one of the underlying dimensions, either human rights, labor, environmental, or anti-corruption. And of course, those screens are also part of our funds in this case. So it's a definition. If you look at all the different dimensions that are taken into account in exclusion-based products, this is one of those dimensions. UN Global Compact and controversy screens, etc. They typically sit next to a whole range of other exclusions that might have to do with the source of revenue generation, such as alcohol, gambling, tobacco, etc. So that is one area or one type of exclusions, and next to that, there are also exclusions which are linked to the UN Global Compact. I think that is a good way of thinking about it and of understanding how that fits into the construction of portfolios.
Thanks. And then, I mean, I think we've got some questions in that I think are all perhaps speaking to the same thing, which is that where is this going in your view? Is all the money that you described in your first slide that's moving into these ESG focused products, is that going to change the nature of not only the world of investing but the world of business in such a way that ESG's ultimate goal should be that ESG becomes the norm, and as such it falls away as a term in its own right and it just becomes investing? Talk to a little bit to where you see the future of this whole movement going.
Yeah, I think this is a fascinating area, certainly, and I think there are very different expectations and theories as to what will happen. And for a recent study that we composed, we actually looked at performance expectations linked to ESG investing. And interestingly, when we looked at all the different theories and forecasts for what's going to happen to good ESG stocks as compared to bad ESG stocks on the performance side, we found theories in support of pretty much any possible outcome. We found theories in support of ESG stocks outperforming non-ESG stocks. We found theories in support of ESG stocks underperforming non-ESG stocks. And we found theories in support of ESG stocks not performing any different from non-ESG stocks. So even if we look at theories and academic publications, there isn't really any agreement as to the impact of ESG considerations and on performance. So if we could say that ESG stocks would definitely outperform or would definitely underperform, I think this would would make it easier to then make any forecast as to where assets might flow towards, whether they would move towards ESG funds, away from ESG funds, or if we would reach some equilibrium at some point. But in light of all the unknowns, also even on the theoretical side, I think it's very difficult to really make any forecast as to where this will go. I think what definitely there appears to be more and more of an agreement that there are a lot of ESG related factors, risk factors, that are indeed financially material. On the climate side, for example, that climate change is or might be a risk that is financially material, and that acknowledging for certain companies and certain industries that climate change is in fact a risk, and that it's important to address that risk, is something that will or this is definitely an area where I see some increased agreements going forwards around ESG, or at least certain elements or parts of ESG being considered as financially material risk factors that are worth being addressed, and also considered in portfolios, of course, at some point.
That links really nicely into another question which we've had, which is, do we weight the EBS and the G equally when making these decisions, or how do we think about incorporating those three factors, which won't always be in alignment with each other, into that decision making, and is there a preference for one over the other?
I think that is something that can be subsumized under the issue of ESG investing being highly individual. There isn't really any good advice or correct or bad advice we can give. I think at the end, this is really something that investors need to decide for themselves, depending on what they believe is the issue they want to see addressed.
Yeah, no, I quite understand. And then I think just as we begin to move to the end of our session today, I'd just like to revisit this topic of stewardship, because I think it's so interesting to hear about the way that the big asset managers are, the representation they have on boards around the world, and actually the power of that representation, the power that comes with the vast amount of share ownerships that they have. Now, I appreciate you're not on the stewardship team, but would you just be able to tell us a little bit more about how you think about that role?
Yes. So let me see if I have slides. Can you see the slides here go into presentation modes? Is that visible on the screen?
Yeah, I think so.
Okay, great. Well, this slide is one that talks a bit about our investment stewardship program and the areas that are important and that inform some of our decisions. And we think what we focus on in our investment stewardship activities focus on four main areas. The first is the board composition. Here we believe that it's important that the board is independent, that board members are capable, experienced, etc. So I think, and this ties back to what I said initially, that the governance side is predominantly about how objectives are set, etc. And the board composition is, of course, a quite important element here. The second is about executive compensation. So here it's about making sure that compensation policies are linked to long-term performance, etc. We have on the right-hand side the governance structure, which looks into things as whether or not a governance structure gives enough rights to shareholders, empowers shareholders, and ensures the accountability of the board and the management, so that those are principles that inform the interaction of our investment stewardship teams with companies that we hold stakes in. And then lastly, and I kept this for last, it's about risk and strategy. This is where a lot of ESG related elements fall into. And here we have the understanding that certain ESG elements are definitely financially material, and that it's important that they are understood as such, that the board of companies is aware of ESG related risks and addresses them properly. But of course that can deviate from company to company, that can deviate from industry to industry. There are certain ESG related risks that are more or less important for certain companies or for certain industries. So here industry knowledge is important, but then at the end it is important for us to make sure that that companies and the boards of companies are aware of ESG related risks, and that if there are ESG related risks that matter to them, that are important to their future cash flow generation capability, for example, that they are properly addressed. And then lastly, we share this slide, and I think we've seen a similar slide earlier on in the presentation. Those are the means, so to say, that our investment stewardship team employs. It can be advocating, it can be engaging with executives, for example, with regulators, with thought leaders, and lastly, it can be done via voting. So I think that is how our investment stewardship team operates. It's based on a set of principles, and based on that set of principles, it then interacts with companies through specific activities, as you see here.
Fantastic. I mean, it's just such an interesting aspect to the work that goes on behind the scenes in the asset management profession that, you know, I certainly, speaking for myself, had a very limited understanding of until today. So thank you so much for sharing that with us. Right, I think, Jan-Carl, we're moving to the end today. So I think it just falls to me to say thank you so much for joining us. It's been really interesting. I mean, our hope is that we can use these webinar series, or this webinar series, to provide a space where we can bring in really great people to teach us and to teach our clients and open all of our eyes to, you know, the really exciting stuff that's going on. So thanks for being a fantastic part of that today.
Thanks a lot. Thanks for the invitation.
I really appreciate it. Fantastic. Okay, well, thanks as ever for joining us today. That's really appreciated. A recording of this will be going up on the website in the next couple of hours, I hope. And so it will be there for you to watch again if you'd like to dive in. Thanks very much, everyone. Cheers. Enjoy the rest of your day. Bye.